Hello, beautiful people. Bonjour, mes amis. Buongiorno, amigos. I hope you're all having a wonderful day and that all of your real estate dreams are coming true. September was an interesting month in Ottawa real estate. Some of the stats are pointing to a potential slowdown across the board, while others not so much. So we'll tell you all about that, and we'll also tell you about a significant change to lending rules that will have a major impact on mom and pop real estate investors come 2026. All right, so we've got Ollie and Emma behind the camera, we've got Andrew on the edit, and we've got a very special October 2025 Ottawa real estate market update coming right up. Let's hit it.
Sarge Puppy knows Ottawa real estate market update. The best update in the business. The best update in the business.
All right, so Ollie and Emma weren't expecting that. This is gonna be like Ottawa Real Estate Market Update, the musical this month. All right, so we'll see how it goes. So yeah, let's get right into it. Let's jump right into it and let's get to those October freehold sales stats, shall we? Huh? Whoa.
Look at all the freehold sales. The freehold sales. The freehold sales. Oh, my God. The freehold sales. Can't you see them?
This whole update would be a whole lot less awkward if I had any rhythm. Anyway, so in September, we sold a total of 738 freehold homes here in Ottawa. And no, I'm just kidding. I'm not gonna do that for everything. But this is your usual reminder here that when we talk about freehold, okay, we're talking about any residential property without condo fees. And our sales total of 738 in September was a pretty decent drop off from August, the month that comes before September, where we sold 786 freehold homes here. That being said, this year's total did blow away last year's September total of 688 sales, and it was the highest September sales total we've had since 2021. So all in all, not bad. Right? Now, in a big picture sense though, 738 sales still falls on the low end of what's been a typical September range for the past decade plus, right? And in that range, if you're curious, would be anywhere between about 700 and 900 sales. Now, the average sale price for September came in a hair below 790K, which is quite strong. In fact, it's the second highest September average on record, falling just short of our 2024 September average of about 794K. So we're like less than 0.5% below that this year, or about 0.5%. So average price and sales volume overall were quite solid in September of this year, right? And if you were to focus on those two stats alone, and let's be real, they're arguably the two most important stats, you'd say our freehold market is in a very good place. But our indicator stats for September, inventory, sales to new listings ratio, and days on market tell a slightly different story. Let's start with inventory, which I will remind you is, Ollie, tell them what inventory is.
Supply and demand.
Ollie got it wrong again. 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 Ollie got it wrong again.
Oh my God. All right. Well, Ollie, just so you know, I did have two songs ready to go there. I was really hoping to play the other one. But as usual, ask Ollie a question, he just throws out words. He doesn't put full sentences together. Inventory, which is a stat that is measured in months and looks at the relationship between supply and demand. You needed to have relationship in there, Ollie, to get the other song. Anyways, so inventory in September rose in Ottawa. All right. We started September with 3.49 months of freehold inventory, and we ended it with 3.78 months of freehold inventory. Now that's an indication that supply outpaced demand in September, which is not unusual at this time of year. Okay, in fact, we mostly expect it. However, 3.7 months is the highest freehold inventory total we've seen here in almost 2 years, right? Since December of 2023 to be more exact. These indicator stats are far from perfect, but in a balanced market, we would typically expect inventory levels to fall somewhere between about 3.5 and 5.5 months. So in the grand scheme of things, 3.78 months of inventory is not some super high number. In fact, it's far closer to the seller market side of the spectrum than the buyer market side. But the fact we're seeing inventory creep up to levels we haven't seen for at least a little while now, at a time of year when things would typically still be moving well, is something that's worth keeping an eye on. Not saying it's a thing yet, but it could be a thing. Moving on, our sales to new listings ratio for September came in at 39%, which could also be a thing. So a little bit of context here. Sales to new listings ratio is another stat that looks at the relationship between supply and demand, albeit in a slightly different way than inventory. Some people swear by one, others swear by the other. We like to be thorough, so we always look at both. And in a balanced market, we expect our sales to new listings ratio to fall somewhere in the 40 to 60% range. And that's where it's been for many, many months until now. Anything below 40% is considered to be an indicator of a buyer's market, right? So now obviously at 39%, it's actually like 39% and a bit, we're rounding, we're just barely outside the balanced market range, but it is the first time in a while that we've seen the sales to new listings ratio come in this low, all right? And so that's another indication that at present, we're seeing freehold supply enter the market at a rate that is far greater than the current demand. All right, finally, our third indicator is average time to sell. And for September, homes that sold on average took 33 days to do so. In a balanced market, we expect that stat to be in the 30 to 60 day range. So we're actually on the low end of that here. All right, so on the whole, we had some mixed signals last month as far as freehold properties are concerned. Sales volume was fine, prices were strong, but then our indicator stats pointed to what might be some underlying weakness, right? So like, what do we make of it? In general, I'd say the market is definitely slower right now than it has been in recent months, but overall, it's still a balanced market. Good product that is priced right will still absolutely move in this market, but it may not like fly off the shelves the way it would have a few months ago, right? So even if you've got a good property, then it is well priced, you might have to exercise a little bit of patience right now. The other thing I would say about the freehold market currently is that it's a bit of a stubborn market. And what I mean by that is that there are buyers out there who are ready to buy, but they're not willing to pay what most sellers still expect to get for their properties. And then a lot of those same sellers are choosing to just hold on until they get their price. So what that all means is that we are seeing offers in this market, but in a lot of cases, the buyer and the seller just can't or won't bridge the price gap required to get a deal done. I could tell you personally that over the past 2 or 3 weeks, I've seen a few deals or potential deals fall apart over what I would consider to be relatively small amounts, right? So like we go back and forth and then we finally get to a point where we're pretty close, but neither side is willing to budge any further and things just kind of fall apart, right? So both the buyer and the sellers in these situations think they'll get their price if they just wait it out. And obviously only one of them can be right. So it's a bit of a slippery slope for both sides right now. If you're right as a buyer or a seller, then great, you get the price you wanted. But if you're wrong, well then hey, tomorrow's price may look a lot worse than today's. Anybody who's worked with me or pays attention to these videos knows how I feel about trying to time the market. So I'll save you the soapbox spiel here. But yeah, that's kind of where things are right now for the freehold market. And that will do it, ladies and gentlemen, for freehold. Now let's talk about condos, shall we? All right, so we're gonna get those condo stats up on the screen for you in 1, 2, 3, and
I can't sell a condo in Ottawa, Ottawa in September. It's hard being a realtor.
Thanks, AI music maker. To be fair, I did sell a condo in Kempville last month. So there, We will work on it, but in the meantime, the collective we sold a total of 247 condos in Ottawa this September. That total was down a fair bit from the 268 condo sales we saw in August, but it was right on par with last year's September total of 248. Right, so in a big picture sense, 247 sales it's an okay September total. Over the past decade, we'll typically sell between 200 and 350 condos here in September. Now, the average sale price of a condo for September came in at about $425,000. And of course, those who pay attention to these updates know what I'm about to say. Emma, you pay attention, right? Tell them what I'm about to say. Well, all right, here we go.
Emma has a lot of tattoos, but she never pays attention. Emma has a lot of tattoos, she'll tell you if you listen. Emma has a lot of tattoos, and it's probably worth mentioning. Emma has a lot of tattoos, but she never pays attention.
I only had one version of that song for what it's worth. Ollie, I had two versions. I thought you might get it right. For Emma, just the one. Just the one. What I was about to say is that condo prices here have been flat for over 3 years now. So that's what I repeat every month. The condo prices here have been flat for about 3 years now. And what that means in practical terms is that in almost every single month in that span, 3+ years, the average condo price here has landed somewhere between about 410 and 455K, right? So in August, last month, we came very, very close to the bottom end of that all too familiar range. September's average bounced back up to be a little closer to the midpoint, right? So nothing really all that newsworthy there. And just an important distinction for you though, when we talk about prices, when we say that condo prices have been flat for over 3 years, we're referring to the citywide average sale price, right? So we're generalizing a fair bit. We've mentioned this a lot in recent months, but there's a pretty big difference right now between the market for downtown apartment style condos and everything else condo, right? So like townhouse condos, apartments outside of downtown, etc. And it's that everything else segment that has done a lot of the heavy lifting over the course of the past little while when it comes to that average sale price for condos, right? That citywide average. So when it comes to the downtown apartment condos, unfortunately, I think that outside of a few exceptions, if you bought at any point in the past, let's call it 4-ish years, and you're selling that same unit today, no upgrades or anything like that, you're likely looking at a lower sale price than what you paid. That's just the unfortunate reality of the downtown condo market right now. You've got to price very competitively in order just to have a chance to sell. All right, so moving on, September also saw condo inventory spike to 4.77 months. All right, now while that's technically still within the high end of the range we would expect in a balanced market, 4.77 months of citywide inventory is the highest level of condo inventory we've seen in Ottawa in almost 8 years. And once again, it's downtown condos that are playing a huge factor here, right? Downtown apartment stock condo inventory is currently at 7.5 months. That's way, 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 way into buyer's market territory. And speaking of buyer's market territory, September's citywide sales to new listings ratio for condos came in at a measly 35%, which also falls well into buyer market range. And last but not least, our average time to sell for condos in September was 45 days, so not quite as grim there. That one falls squarely in the middle of our balanced market range. So if you are someone who is thinking of buying a condo, especially if you want to be downtown, this is a very good time to be shopping for deals. You won't find it on new construction, but the resale market has some great opportunities right now if you know where to look. All right, so that'll do it for condos this month. Now, allow me to update you on a very important news item before we wrap. And by now, you've probably figured out the pattern, how this is gonna go. Ready?
What's the word? What's the word? What's the word in the news? Tell me, baby. What's the word? What's the word? What's the word? Tell me, baby. In the news.
That one went pretty hard. I'm not All right, so we're gonna be relatively brief this month. We don't have any big scandal to tell you about, but there was a very important change to lending rules that was announced, which could have a major impact on your ability to purchase an income-producing property. The change comes to us from our friends at OSFI, right? That's OSFI, and it stands for Office of the Superintendent of Financial Institutions, right? So in addition to having a stupid acronym for a name, OSFI is also the federal regulator in charge of supervising banks and lending institutions and insurers, right? So in a nutshell, OSFI sets guidelines that all banks and regulated lenders have to follow, okay? And OSFI just announced that starting in early 2026, banks and lenders will no longer be allowed to count a borrower's, that's a hard one. So banks and lenders will no longer be allowed to count a borrower's salary more than once towards the purchase of income-producing properties, right? And this change will severely hinder small real estate investors' ability to qualify for financing, much less build a portfolio. Now, for anyone who's not quite following, allow me to paint you a picture that will explain all of this in much more practical terms. All right, so let's say you make $100K a year and you have no debt. You also have a down payment saved up and you decide that you would like to purchase an income-producing property. So first thing you do is you reach out to a good agent who has a deep understanding of that side of the business. Oh, here's one. And then together, right, you identify, you work, and you come to identify a great little multifamily property that generates, let's say, $500 per month in positive cash flow, right? So that's $500 in your pocket each month after mortgage, taxes, insurance, and all other property-related expenses have been paid. So you would then go to a lender and ask for a mortgage to buy this great little property, right? And obviously, before they decide whether or not to give you that mortgage, the lender will need to know how much you make per year, right? So you show the lender that you make $100K, the lender confirms that the numbers all work, and bingo bango, you've got yourself an income-producing property. Now, let's say you have another down payment saved up and decide you want to buy a second income-producing property. And let's say that with the help of your trusty real estate professional, you identify another multifamily property that is just like the first one you bought. Same price, and it also generates $500 per month in positive cash flow. So you go back to your lender, and that lender will once again need to confirm how much you make per year before deciding whether or not to give you another mortgage, right? So here's where it gets interesting. Under the current rules, in this example, the answer to how much you make per year is now $106,000. You still have your $100K salary, plus you now also have $6,000 per year in added income from that first property. So your financial picture has objectively improved. And that's more or less how many lenders would view it as well. And so you'd be able to qualify for that new mortgage. Under the new rules, however, which again are set to take effect in early 2026, accredited lenders would no longer be allowed to include your $100K salary to qualify you for that second property, because the salary was already used to qualify you for the first. All right, so in other words, in this example, under the new rules, a lender is now required to treat you as someone who makes $6,000 per year instead of $106,000 per year. And of course, if your annual income is $6K per year, you're not getting a mortgage from any traditional lender. So that's how this change will work in a nutshell. And here's the thing, if you're already super rich, this could actually end up benefiting you, but it will make it much harder for everyday people to purchase rental properties in Canada. So now that you're caught up, allow me to share a few thoughts on this all before we wrap. First and foremost, and because I like to try to present like a somewhat balanced take on these things, I can certainly see the logic in placing some sort of limit to the number of times a person's salary can be counted when it comes to the purchase of secondary properties. Like, of course, your salary shouldn't just be counted to infinity. Okay? But here's the thing, every regulated lender in the country was already protecting against that. So you see, OSFI sets the minimum qualification standard that lenders have to apply, but then those lenders are allowed to apply any additional restrictions they choose. And I can tell you for a fact that there's not a lender on the planet Canada who would allow someone who makes $100K per year to take on like dozens of mortgages, much less millions and millions and millions of dollars in leverage. So the biggest question that came to mind for me when I read about this new policy was, what problem exactly are we trying to solve here? Are we trying to solve the problem of that darn middle class getting ahead? Like, are we trying to solve the problem of rental housing becoming too affordable for end users, right? Like what the f are we doing here? And by the way, the statistics show that those small mom and pop or individual landlords on average provide much more affordable rental accommodations than the big boys, right? The big housing for profit corporations. And I can also tell you from experience that yes, there are bad landlords across all segments, from mom and pop landlords to big corporate landlords, but there's really no such thing as an amazing big corporate landlord. The best ones in that group mostly just kind of suck less than the rest. The very best landlords, the ones who genuinely care about their tenants, who take pride in their properties, are almost always the small individual investors. So these new rules, in my opinion, are not going to benefit tenants. They're not going to help the middle class, and they sure as hell aren't going to help make rental housing more affordable in Canada. And hey, wasn't that kind of the whole point? Like, I seem to recall a recent federal election where, bloated orange racist aside, making housing more affordable was kind of like the big issue. And so the cynic in me looks at the current landscape and sees that, one, a lot of these new federal housing incentives are really only accessible to those with very, very deep pockets. Two, in recent years, a ton of big Canadian developers, who obviously carry a lot of sway on Parliament Hill, have shifted their focus from building the kind of properties they used to sell to end users and small investors to now building large-scale rental properties either for themselves or to sell to large-scale corporate investors. And three, we have a new federal government that has expressly stated that it intends to get into the business of housing. So again, the cynic in me can't help but look at this landscape and wonder if these new OSFI lending restrictions are really just a way of like clearing the competition. Make no mistake, what we are essentially doing here is that we are handing the Canadian rental market to large corporations on a silver platter. And if you think that that's a good thing for housing affordability in this country, especially in the short and medium term, I'd say you should probably think again, right? And that's me being nice. One last closing thought for you here, because we like to end on positive notes all the time. I think that for a lot of this stuff, you know, where there's a will, there will always be a way. I firmly believe that there will always be opportunities available to determined and hardworking people, you know, in real estate and in just in life in general. And so I'm confident that in spite of these new rules, we will continue to find ways to help people who genuinely believe in the long-term benefits of owning real estate and who want to provide quality housing to those who need it. We may just have to get a little more creative in order to do so, starting in 2026. And with that, dear friends, we're gonna wrap it up for this month. I'm Serge Actually, you know what?
How's the housing market? The first question I hear. There's a lot to consider. It's tough to answer it here.